Growth in the top-heavy U.S. life reinsurance market has been a challenge in recent years, mainly due to limited growth by direct writers. Here to discuss a new report out on the sector is AM Best Senior Financial Analyst Mike Adams. And as the report title says, the market appears poised to grow. And Mike, some pockets of growth opportunity appear to be emerging. What are you seeing coming into the market?
Well, John, just the overall reinsurance market, the top global reinsurers are kind of struggling to grow their top line. And this could be partially attributed to direct carriers struggling to grow their top line. These larger carriers are operating in the mature U.S. and European markets, and it's kind of difficult to grow at above average rates in a saturated marketplace. So what we're seeing is these carriers moving to emerging markets where we're seeing pretty strong growth rates, particularly Asia Pacific, and China really has seen the strongest growth. Now, a lot of that Chinese growth is coming from Chinese domiciled companies, but with the explosion of the middle class in China expected to continue, we think that there's a lot of room there for global insurers to grow there, which will help the global reinsurers. We're also seeing growth in the longevity space. Historically, the UK has been the place where we've seen the most growth for longevity and longevity transactions. However, we're seeing more transactions now in Europe and in North America. And we do expect that trend to also continue as companies want to lay off their pension risks. And if interest rates behave, we believe that that trend will continue.
Now, the market's pretty concentrated these days. Do you think there's room for new entrants? And if so, how will the new players fare?
Well, I think it's going to be somewhat difficult for new entrants to kind of break that barrier of the top 5 global reinsurers. I mean, you have Swiss Re, SCOR, Hanover, RGA. And it's just these companies have been around for a long time. They've established their relationships with their ceding companies. They're really viewed as strategic partners. I mean, they have decades of experience. So the services they can provide, it'll be kind of hard. It is going to be difficult for new entrants to kind of match that level of services and experience. They may be able to get some cedents may want to diversify their counterparty exposure a little bit, so they may get some of that business. But for the most part, we're seeing is the new entrants interested in acquiring blocks of annuity business. And a lot of these carriers are backed by private equity.
Now, cession rates have been dropping fairly steadily lately since the highs we saw of about 2 decades ago. Is this a trend?
Yeah, cession rates had dropped quite precipitously over the last decade or so. The last 3 years or so, we were seeing a slight uptick in cession rates, and we think it's due to a number of factors. One being principle-based reserving, the introduction of the 2017 CSO table, and also due to the significant increase in automated underwriting. So carriers are looking to reinsurers for their expertise on pricing that business, so that's very important, and maybe trying to lay off a little bit on that risk.
Thanks, Mike.
You're welcome, John.
You can find the full report online at ambest.com. And for AM Best TV, I'm John Weber.